Hi, I'm Justin Miller with the Chong Miller Group, and welcome to part two of the three-part mini-series, Inflation, Interest Rates, and the Housing Market. If you've not yet watched part one about inflation, I strongly suggest you watch part one before continuing into part two. Part two is dedicated to interest rates. Subscribe, smash the like button, sit back, and learn now about the interest rate market. As inflation goes higher, it becomes more expensive to engage in the level of consumption that one's used to engaging in, the consumption they'd engaged in yesterday, the day before, the year before, what have you. And that means either people need to find some other source of funds to support their level of consumption, or they need to reduce their level of consumption. And so inflation feels bad, right? It costs more to do what we used to do, or we can no longer do what we used to do. We've got to substitute, or we've got to cut down. So interest rates. One of the reasons we want to talk about interest rates is because sometimes the government uses interest rates to try to influence the level of demand in the economy, and thereby influence the level of inflation in the economy. Now, this is accomplished through the U.S. Federal Reserve, or the Fed. In other countries, their equivalent to the Fed is just generally referred to as their central bank. So the Federal Reserve is the central bank for the United States. Central banks have slightly different rules across different banks, but they have the ability to directly and sometimes indirectly alter certain types of interest rates. And so the US Fed has the ability to directly state, in fact, what will be the interest rate for what are referred to as Fed funds rates. The Fed funds rate is an overnight lending rate that is available to banks. So it's very short term, less than 24 hours, and it's available to a very limited number of people. Banks, that's it. That's the interest rate that the US Fed actually controls. But through changing the Fed funds rate, there's a belief that the Federal Reserve can influence interest rates across the entire time spectrum for which bonds exist. Bonds are the accumulated loan documents of a particular category that they may be bought or sold. Right? In the US, we have this market economy, and the market economy allows us to buy and sell pretty much anything, unless it's specifically stated as contrary to public policy. In the US, in a market economy such as the US, you can buy or sell pretty much anything. And because we're an economy of 330 plus million people, we engage actually in transactions around most anything. And so you can buy or sell houses, obviously. You can buy or sell food, obviously. You can buy or sell money. And money is bought or sold over periods of time, right? It would not make sense to engage in the cost of transaction to go find somebody who wanted to trade their $1 bill for your $1 bill, right? So if there's no time involved, money does not have a valid market in which you could engage. You'd just simply be passing your dollars back and forth and experiencing transaction costs for no potential of gain. But if you want to buy money now to use now to be paid back later, then we're going to charge you for that, and that's going to be an interest rate. On the other hand, if you happen to have surplus money sitting around and you're willing to let other people buy access to that money from you, you'll be paid back that money plus some additional money, interest, over a period of time. And so there's a well-functioning money market in the US and in some other countries around the world. And so those loans, right, we could call them loans. If we buy and sell money over a period of time, we create a loan instrument. That loan instrument states certain things. It need not state all of the different parameters because at least one of the parameters could be calculated. We could state how much is being loaned, how much will be paid back, when it will be paid back. We could calculate interest. Or we could state interest and how much is loaned and when it'll be paid back, and we can figure out how much is going to be paid back. Or, we could, any number of those variables. If we've got 3 of them, the 4th one is easily calculable. So loans are made. And actually, this is a really important point about the US economy, and I'm going to diverge onto this point just to make certain things clear. The US economy runs not on oil, not on food, not on people. Those things are all important. The US economy runs on leverage. Leverage is the ability to borrow money, to use it at a particular time and place for need to be paid back at some other particular time and place. Now, we all use leverage. I may not want to carry lots of cash around with me. And so I use a credit card. I go into a grocery store, I use a credit card. I go in the gas station, I use a credit card. I go to the barber shop, I use a credit card. Whatever it is, I go to a restaurant, I use a credit card. The movie theater, etc. I don't need to carry cash with me. Well, I'm borrowing from someone, from a bank, every time I use that credit card. And I have to pay back that loan. Now, I could pay back that loan instantly when I get home. I could pay back that loan once a month. I could decide not to pay it back all right now and carry some of that debt burden for a while. So I'm shifting my time of acquisition of money and my time of use of money to be more convenient for me. I'm using a credit card to do that. I'm using somebody else's money to engage in these purchase transactions in exchange for my providing my money back to those sources of funds when I'm supposed to pay them back. Well, it's not just me and most of you that do that. And it's not just about buying consumer products. We could go to our stock brokerage and we could say, we'd like to buy some stock. And maybe we decide we're going to buy that stock on margin. And margin accounts generally are 2-to-1 in the US. So if I put $1,000 in, I could buy $2,000 worth of stock in my margin account. I'm leveraged 2-to-1. And that allows me to gain access to capital investments at twice the level that I could from the money that I actually put into the account. Now, why would I do that? Let's say I bought a stock at $10. I bought 100 shares of stock at $10. That's $1,000. And that stock goes to $20. And then I sell it. I sell 100 shares at $20. It's $2,000. I just made $1,000. I invested $1,000 and I made another $1,000. I've got $2,000 at the end. That's nice. I've doubled my money. Okay, that's 100% return on my investment. And let's say they did that over 1 year, just for ease. So I made 100% over 1 year. But what if I bought not 100 shares at $10 a piece, but I bought 200 shares at $10 a piece? The beginning of the year, I put $1,000 of money, my money, into the stock market, into my brokerage account. The broker lends me, gives me margin for another $1,000, and I buy 200 shares at $10 each, $2,000 worth of some particular stock. And at the end of the year, That stock has doubled. It's gone from $10 to $20 a share. I sell that stock. I'm selling 2,000 shares at $20 a share, or $4,000. So my $1,000 investment has now turned into $4,000. Now I've got to repay the broker. So I give them back their $1,000, but I'm left with $3,000. I pay myself back $1,000. I've got $2,000 of gain, right, in my pocket. I've got $2,000 of gain, and I had made an initial investment of $1,000. So at the end of the year, I made $2 for every $1 I put in. I made 200% return on my money, right? The stockbroker got all their money back, and I made twice the return that I had made initially in the first example. In fact, because of the way I gave the example, I made twice as much money, not just twice the return. I made twice as much money. I didn't just get $1,000 extra in my pocket. I got $2,000 extra in my pocket. So we use, for the purpose of buying capital assets, we may use leverage. Well, what about a house? Capital investment. Most people borrow on a mortgage to buy their house. And so what do? They go out and they secure a mortgage. They put some amount of money into the loan. Now, a conventional loan, you put 20% down. So you're borrowing 80%, or 4 times the amount that you put in, right? The stock brokerage, it was 2-to-1. Here it's 4-to-1. But I might be able to get a conventional loan, you can, for putting down just 5%. And you borrow then 95% of the money to purchase your house. That means I'm borrowing 19 times what I put into the house. That's leverage. Well, it's more consequential to the U.S. economy than that. And that leverage is super important in houses. One, it allows us to buy houses that we never could have otherwise. It allows us to experience real wealth gain that we would not be able to, in all likelihood, otherwise. But leverage becomes more important than just that. The U.S. economy runs on leverage. If General Motors wants to pay a salary to its employees, it borrows that money and makes the payment to the employees. Why? Because they may not happen to have the cash in the account to make the payment today. Why? Because General Motors gets money coming in the door when cars get sold, but they need to pay their employees every 2 weeks. So they know they've got an amount of money that goes out the door every 2 weeks, irrespective of when car sales actually take place. Car sales maybe don't take place every 2 weeks. Maybe they come in dribbles and drabs. Maybe suddenly there's a great big sale to a fleet, and there's no other sale to a fleet for another 3 months. So General Motors goes out and they borrow money to pay a salary, and they borrow money to pay suppliers, and they borrow money to pay everyone else. And I'm not picking on General Motors. This is how the economy works. Cash flow in comes in when it comes in. Cash flow out gets financed. And so if you didn't have the ability to borrow money to pick up that leverage, the economy would have a significant problem. We'd have to change the way that we paid people. We'd have to change the way we paid suppliers. We would actually start to shrink really quickly. That leverage is really important. But in the bond market, where we've got the accumulation of all of these loans that may be traded between buyers of loan products and sellers of loan products or bonds, interest rates get set. You may think, wait, I thought that I picked my interest rate by going into the market and picking who the lender was that gave me the terms that I want. Yes, in some manner that's true at a micro level, but the overall parameters are set by the larger market in bonds. And so there are different types of loans and different types of bonds, therefore. There are treasury bonds, long-term government borrowing costs. They're funded through the sale of treasury bonds. There are shorter-term treasury notes. There are, of course, the overnight federal funds rates. There are mortgage-backed securities, which are accumulations of mortgages. And the mortgage-backed securities market functions such that people who want to buy the cash flow, those monthly payments, can buy mortgage-backed securities and get those monthly payments. Those people who don't really want the monthly payment, they want all their money now so that they could go out and make another loan or repay their shareholders or whatever. They can sell their mortgage-backed securities. There's nothing wrong, nothing esoteric, nothing weird. That's been going on for hundreds of years. Mortgage-backed securities a little bit less, because the modern mortgage started in the early 1950s through some innovations brought on actually by soldiers returning from World War II and then from the Korean War. So we can date the modern mortgage, the 30-year fixed rate loan, back to the mid 40s with some significant improvements through the early 50s. And that created the mature mortgage-backed securities market that we have today. That market functions in this way. If there are more people wanting to buy mortgage-backed securities, that means that demand for mortgage-backed securities goes up, right? Because more people are wanting to buy. More buyers are coming into the market. Demand goes up. When demand goes higher, that increases prices. So the price of mortgage-backed securities goes up. Now, interestingly, a definitional feature of bond, of a loan, is that the interest rate paid by that loan goes down as the price goes up. It's definitional. It may be easy to understand. It may be hard to understand. Maybe you don't want to agree with it. It doesn't matter. It's definitional. If prices go up on bonds, interest rates go down. As prices go down on bonds, interest rates go up. So the more buyers that come into the mortgage-backed securities market looking to buy mortgage-backed security bonds, MBSs, the higher the price, the lower the rate on those bonds, right? Because somebody's paying more. They know what that bond is going to pay at the end. They know when it's going to be paid, but they're buying it for more money. So maybe it was initially issued at $100 would get you $110, but they're not paying $100. They're paying the seller $109, and they're going to get back in 1 year $110. So that means they're only getting 1% interest rate, a 1% return. Well, the initial issuer was going to get 10, right? The terms of the loan are set, and that is when repayment occurs, what the repayment amount is, and what the face value is on that bond. But you're actually paying different than the face value, right? So your interest rate that you're collecting becomes 1%. As buyers leave the market, no longer desirable, don't want these bonds, demand goes down, prices consequently go down to try to entice people to come in, which means interest rates have gone up, right? Why would somebody want to come in? Well, I used to only be able to get 10% for my money, but today I can get 20% for my money. I can get that bond that was written at $100, I can get it at $90, right? $90 means I'm making 20% of my money. I can buy that bond for $90 and get $110 in 1 year. I'm making $20. I'm making 20% on my investment in this mortgage-backed securities bond. So price went down, interest rate went up. And the interest rate going up causes that bond to be more valuable to me, which causes me to come in and make that purchase. So bond prices going up mean interest rates going down. Bond prices going down mean interest rates go higher. That's important to understand the way the bond market functions and what it means for the way in which the Fed may interact in the bond market. It is actually a really interesting question. How does the bond market determine what the appropriate interest rate should be? So there's a couple of theories about the ways in which bonds get priced. Traditionally, the belief has been that bonds are priced such that they return an amount referred to as a normal rate of return, actually, an amount over inflation that compensates for risk with the particular assets in that particular portion of the bond market. So if we were in a 1% inflation environment and the risk that mortgages in mass would default was maybe requiring an additional risk premium of 1%, then we might see mortgage rates at 2% because lenders, people buying up those bonds, are going to require they be compensated for inflation because otherwise they'd be losing money, and for the risk that they're taking in making the investment, the risk that they could actually end up losing money because the assets in the mortgage-backed security are potentially losing assets. Well, that normal rate of return in a particular portion of the bond market is interesting. It makes complete sense. And in some general sense, that's what we see, but not always and not specifically. Not only is the market subject to speculation and manipulation, but there's something else that takes place more generally in the bond market that's really become discovered since the financial crisis in 2008. And that is that buyers of bonds are highly risk adverse investors. And by that, I mean they worry they're going to lose money. And in fact, they worry they're going to lose all of their money. And so we can think of this actually as some investors buy bonds, right? They do, and those bonds return some level of interest, and that level of interest on a 30-year U.S. Treasury bond right now is about 3%. So that means that over 30 years, those investors look over that time horizon, people buying those U.S. Treasury bonds, which are 30-year bonds. They look over that time horizon and they say, inflation may go up, inflation may go down, it may go up and then go down, and then up again, right? It could do a whole lot over a 30-year period. And the risk that the U.S. government may default is whatever that risk is. It's assessed by individuals making decisions about buying U.S. government bonds. So today, over the past 2 months, the inflation rate has been running at over 8%. So if I'm a bond investor and I'm thinking I need to be compensated for 8% inflation plus a risk premium, the government could go out of business. If the government were to go out of business, Congress and the president decide they can't agree and they just shut down the government, right? Maybe shut down the government for a couple of months and bond payments get missed. Not totally outside the realm of possibility. Countries have absolutely done that. Countries have gone bankrupt, including big countries. The Soviet Union in the 90s effectively went bankrupt. And so there should be a positive risk premium that's put on those bonds. So that alone suggests that right now, U.S. Treasury bonds should be trading with an interest rate over 9%. But they're trading with an interest rate pretty close to 3%. That seems suspicious. Why is that? It cannot possibly be that the risk premium is so low that it's zero, and investors have decided inflation isn't really 8%, it's actually 3%. So there's got to be something else. There's some negative that may get added into the traditional understanding of inflation plus risk premium. So let me take you to a different category of investors for just a minute. When I was doing my dissertation work at NYU, I was looking at the formation of the U.S. hedge fund industry. And I was looking at sort of the creation of the regulatory structure and those who found that creation of the regulatory structure and took advantage of it, because it was not necessarily something that was either advertised or even intended. And then how that industry evolved over time. And something really interesting happens when you're sitting in New York City and you're looking at the formation of an industry, whether in real time or historically. And that is, you have access to a world of really interesting people who operate in that industry. And so I got to meet the editor-at-large of Fortune, who actually gave rise to the name hedge funds, who named the entire financial services industry that we refer to today as hedge funds. And got to interview her as part of the work I did for my dissertation. She introduced me to Warren Buffett, who happened to be in New York at that time, meeting with the Federal Reserve about possibly bailing out one of the investment banks that was in the process of collapsing because of what was going on in the financial crisis in 2008. There were other interesting people I met. So it turns out that really wealthy families, right, like the Waltons, the founders of Walmart, or the Rothschilds, or other names that we see steeped in history who have controlled large legacies for hundreds of years. They all worry about the preservation of their assets. And interestingly, what they don't worry about is making a lot more money. Now, there may be individual members of a particular family who want to make more money, who want to just become the wealthiest that there is. But the families themselves, and therefore most of the members in those families, are concerned with what's referred to as asset preservation. And so if you look at the Morgans and you look at the Rothschilds and you look at the Guggenheims and these other families, they invest very large portions of their total wealth into forests. It's kind of interesting. Why would somebody want to go buy a forest? I don't know. Well, actually, it turns out there's a really good reason. Forests don't go down in value, right? Land may go up a little bit. Land might go down a little bit. But you also have, in addition to the land itself, you have the commodity, lumber. And the commodity of lumber will offset decreases in the price of the land if land goes down. And the lumber can sit there in conservation or what have you. These really wealthy families are concerned about preserving their wealth. And so they buy these assets that aren't designed to make them lots of money because that may induce risk. Rather, they're designed to just preserve the assets that they already have over long periods of time. Bond investors have different risk tolerance profiles than do investors in other types of asset classes, let's say equities, stocks. People who invest in the stock market are looking for return on their capital. They're looking for growth. And they're willing to experience and suffer the volatility of that asset class. Right? Stocks go up, but they also go down. They go up over long periods of time at a fairly understood rate of gain, but they go down over long periods of time as well. And so investing in the stock market could give you a particularly nice reward, but it could also take all your money away from you. People who invest in bonds, they're not looking to lose any money, hopefully. And they're not really looking for large gains, at least collectively, right? You can find exceptions to any generalization of a group of people. Bond investors are extremely risk adverse. And so they may decide they're looking for asset preservation. They may even decide they're willing to suffer certain known levels of loss that they can pre-calculate in order to make sure that their assets are preserved. Well, that sounds ridiculous, perhaps. So during the financial crisis, the US Fed wasn't the only central bank engaged in quantitative easing. The Japanese bank eased so much that interest rates went below zero. Interest rates for government debt were literally negative. In fact, the European Central Bank did the same thing, and European central bank bonds went negative. And the bonds that were issued by multiple of the countries in Europe went negative. And what that meant was literally a bond investor was saying to the government, I will buy your bond, the equivalent of treasury bond, for $100 as long as you pay me back, as long as you promise, no risk, you will pay me back, I don't know, $95 in a year or in 10 years. Rather remarkable. But the climate was such that those with large assets that they wanted to preserve could take those assets and put them in the bond markets with a pre-understood loss that they were willing to accept in exchange for the certainty that they were going to get their money back, that large majority of their money back, at a certain point in time in the future. Now, rates effectively never went negative in the US. There were a couple trading days where very short-term rates did actually go below zero. It was not policy. The US Fed specifically said, we are not going to enter a negative interest rate regime for a variety of reasons. And so they pushed rates to approximately zero. But in certain countries, more than just a handful of countries, you literally, if you wanted to buy government debt, you were going to have to pay for the privilege of owning that government debt by accepting a negative return on your money. Well, that's kind of interesting. But it's not limited to just government debt. If we look at mortgage interest rates over the period of time from 2007 to present, well, until a couple months ago, we consistently have seen mortgage interest rates going lower and lower. In fact, mortgage interest rates have been on a 50-year downslope in terms of what those rates were, from something between 15 and 17% in the early 1970s, all the way down to 2.75% approximately at this time last year. Now, obviously, they popped up a little bit, but But that was a slow progression of mortgage interest rates going lower and lower and lower. And since 2007, mortgage interest rates have generally consistently been below the rate of inflation, including right now, where mortgage interest rates have popped up to that 5.3% range. And inflation the past 2 months has been running about 8.5%. Mortgage-backed securities are actually, those investors are actually accepting negative returns right now. So rates are set in the bond market by participants to the bond market. What do they set rates based upon? The traditional theory, the normal rate of return, inflation plus some risk premium, now better understood as inflation plus some risk premium minus some risk tolerance premium. And the risk tolerance premium is pushing rates down considerably from where we would literally expect them to be otherwise. Now, there's another theory about how interest rates get set as well in the bond market, and that is one of crowding out. It's one of excess supply. So if the government is simply spending too much money, they've got to borrow all of that money. And when they borrow all of that money, there are so many bonds that they issue that bond investors look around at the plethora of choices they have and decide they're not able to consume all of that debt, all of those bonds. And so the demand for that large supply is insufficient, causing prices on those bonds to go down, causing interest rates to go up, until the interest rates become so attractive that more bond investors rush in to accept some of those bonds. Now, that theory, particularly interesting, has been pretty widely disproven over the course of time. Also, since 2006, the U.S. government has been running large deficits for long periods of time. And the U.S. government is by no means unique in this regard. The U.S. government's actually better than a lot of other governments. But the U.S. government decides to issue debt to pay for the things that it needs to do and or wants to do, for which they don't have sufficient tax receipts to be able to make payments. And so they issue debt to be able to buy those things, provide those services. Those debts have multiple years been at record levels, which means multiple years of record bond supply into the market. And the market seems to be insatiable with regard to this bond supply coming from government debt. And it's not just U.S. debt, right? It's Japanese debt. The Japanese, since 1989, have been on a spending spree that is just remarkable. The Chinese government spends money with, I don't want to say reckless abandon, but with reckless abandon. The European Union spends money profligately. It's amazing the amount of government debt that's out there. But on top of that, you've got corporate bonds, you've got junk bonds, you've got mortgage-backed securities, you've got packages of auto loans, etc. The world's demand for debt products, for bonds, actually seems to be close to insatiable. Now, that's not to mean we could never actually approach some point where there is insufficient demand to absorb all of the bonds. But very clearly, we're not there now, and we've actually not approached it there. We've not gotten close to that point. And so bond investors keep coming into the market with lots of assets to buy bonds, even when those bonds are paying rates that are literally below the rate of inflation, literally knowing that they're going to accept a negative return on those bonds to be able to get the cash flow and to be able to have the guarantee, the certainty that they're going to actually be paid off per the bond. And in the mortgage-backed securities portion of the bond complex, this is so true even after the experience of 2008 to 2012, where mortgage-backed security bonds did default in large numbers, right? Not the whole complex and not the majority of the complex, but in large numbers. There were a lot of people who took very significant haircuts on the value of their mortgage-backed securities. Even with that history, relatively recent history, investors in bonds keep rushing in to buy those bonds at rates at which the bond investors know they're actually doing nothing more than generally preserving the value of their assets. So it is actually a really interesting question. How does the bond market determine what the appropriate interest rate should be? Supply and demand of bonds and the risk premia that are set on particular categories of the bond complex. So the risk premium on auto loans may be higher than it is on mortgages, as well as the risk tolerance that bond investors in the aggregate have, where that risk tolerance is so low that bond investors in the aggregate are literally willing to accept known negative returns. Negative returns they know will actually occur. So as I noted, the Fed controls one particular rate, the overnight or Fed funds rate. That's the only one that they literally set. They have the Fed Open Market Committee meeting. The FOMC meeting takes place 10 times a year. And at that meeting, the voting members of the Federal Reserve vote to set the Fed funds rate. And over the past few years, over the past year and a half, the Fed funds rate had been set to 0 to 0.25%. So usually they set a particular point value. They've decided over the previous couple of decades that perhaps a range on the Fed funds rate could be more significant, could be easier to control, could reduce some level of volatility. So the Fed funds rate had been lowered in March or April of 2020 to the range of 0 to 0.25%. So an overnight loan could be anything between free and 1/4 of a point. The Fed has met and twice this year so far decided to increase interest rates, increase the rate on the Fed funds rate, right? So they say interest rates generally, but it's actually just the Fed funds rate. So first they increased the rate by 25 basis points. A basis point is 1/100th of a point. A point is the same thing as a percent of interest. So 1 point or 1%, a basis point is 1/100th of that. So the Fed funds rate increased from a range of 0 to 0.25 to a range of 0.25 to 0.50, or 25 to 50 basis points. They met again last month and decided to increase the rate by another 50 basis points, another 0.5%. And that means that the Fed funds rate has gone now to a range of 0.75 to 1.0%, 75 basis points to 1 point. That's a Fed funds rate. So that's interesting. But the Fed doesn't control the mortgage-backed securities bond market. They don't control the Treasury bond market or the Treasury note market. So adjusting the short term, very short term, the overnight rate, is supposed to adjust across the entire bond complex expectations for what might be appropriate for the bond market itself to set for prices. So in other words, the US Fed has a very limited lever through which it can influence the bond market, but it's the bond market itself that actually is determining interest rates. So when the Fed increases the overnight rate the bond market may say, aha, I could maybe, the participants in the bond market realized maybe they could get more interest on their longer dated bonds. And so if they are not able to, they start selling those bonds, driving down the price, meaning the interest rates go higher because the price is going lower. But it's up to bond market participants to decide, well, what low price do I want to get back in and buy these higher yielding assets? That means, just like all markets, speculation and potential manipulation are possible features of a marketplace. We've all heard of times during which particular asset price bubbles have occurred, where an asset price goes higher and higher and higher for no particular reason, and becomes uncorrelated with any reasonable understanding of what valuation might be. And so one of the very famous asset price bubbles were tulip bulbs in the Netherlands hundreds of years ago, where the buying of an actual tulip bulb could cost you over $10,000, right? There's no reason the ability to grow one tulip plant, so maybe 3 or 4 tulips, flowers, should cost you $10,000. But the tulip bulb mania was a real asset price bubble, and it burst and it came down. Right? We have stock market bubbles that happen frequently. The price of stocks sometimes become uncorrelated with any form of reality of what those stocks should be. Prices go significantly high, and then people realize this doesn't make any sense. They drop out of the market, they sell, those prices come back down, the bubble bursts. And usually the bubble bursting is painful in the same way that the increasing level in the bubble pricing is euphoric. But we have normal price increases and decreases that have nothing to do with bubbles. Why do I make that comment? I make that comment because it's important to realize that speculation as well as manipulation are real features of markets in free market economies. They can be regulated around, but the freer the market, the greater the likelihood that you're going to have speculation and even manipulation. So right now, the Fed funds rate, that interest rate controlled by the US Fed, has gone up by 75 basis points. It went up by 25 basis points and another 50. It's gone up by 75 basis points since the beginning of the year. But the mortgage rate, is determined by the mortgage-backed securities market, has increased from about 3.2% to, according to the Mortgage Bankers Association, MBA, to about 5.3% over that same period of time, less than half a year. So beginning of 2022 to present. In other words, mortgage rates have gone up by 210 basis points instead of 75 basis points. Now, does that mean there's speculation going on in the mortgage-backed securities bond market? Absolutely. Does it mean that mortgage interest rates are high relative to where they probably ought to be right now? Yes. Now, I'm not saying anything about the trend for mortgage rates right now or interest rates more generally. Rather, I'm just saying at this particular point in time, it looks like speculation in the MBS market has gotten the MBS market ahead of itself. But when you get those kinds of issues taking place, the bond market or any other market is likely to correct. Why? Because mortgage-backed securities right now are paying 5.3%. I can't go into a bank and get 5.3%. And mortgage-backed securities, by the way, are very low risk. So I can't go into the stock market and with very low risk get 5.3%. In fact, stocks over the past couple of months of 2022 have been performing horribly. So I'd be losing money if I went into the stock market in all likelihood right now. But I could get 5.3% in the mortgage-backed securities market. I can't go into the treasury market and get US government treasuries to return that to me. I can't make any kind of investment that's kind of small in size that's going to return safely that kind of money to me. So at some point, me, somebody else, investors in bonds are going to realize the mortgage-backed securities market has been speculated into an unstable location. I'm going to go get myself some MBSs because I want to lock in those kinds of interest rates. And that's going to increase demand for mortgage-backed securities, which is going to draw down mortgage interest rates. It's a feature of the market. So MBSs right now are less expensive than they should be. Mortgage interest rates, right? One thing about speculation, it can continue for a while. Mortgage interest rates could go higher. But there's nothing in the Fed policy right now which is driving mortgage interest rates. They're being driven by speculation taking place in the bond market, specifically the mortgage-backed securities bond market. And so they'll come back down. They'll come back down because somebody will realize it's in their interest. And when I mean somebody, I mean large numbers of individual investors will realize it's in their best interest to lock in that 5.3% before other people do, because once people start flooding back into the mortgage bond market, those interest rates will start heading back down, and other people will get not 5.3, they'll get 5.0, they'll get 4.9, they'll get 4.8% on their investment, and I'll be locked in at that 5.3. So the Federal Reserve, starting in 2008, realized they have an additional mechanism through which they can influence monetary policy. And that is what's come to be known as quantitative easing. So quantitative easing is when the Federal Reserve itself steps into the bond market as a buyer. You could have quantitative tightening, actually, if the Fed stepped in as a seller of bonds. But they can't produce bonds themselves, so they have to have a set of bond assets to be able to sell. So you can only have quantitative tightening after you've had a period of quantitative easing, where the Fed accumulates bonds. And the Federal Reserve stepped in 2008 to accumulate bonds, treasury bonds and mortgage-backed security bonds. And then they started tightening again later in the economic cycle coming out of the financial crisis, the recession of 2008 to 2010. In that time period, looking more like 2016, 17, 18, the Federal Reserve started to engage in some level of quantitative tightening, selling off some, but not all, of those bond assets that they had accumulated. With the pandemic lockdowns, the Federal Reserve decided we need to step back into the market and buy a lot, because the economy has been shut down, and therefore there are not other participants who may be actively buying bonds because they don't have the resources to be able to buy those bonds. And in fact, the issue may have been they wouldn't have the leverage because lenders may stop lending because the economy was shut down. And so the Federal Reserve decided they were going to quantitatively ease. And so they started buying large portfolios of mortgage-backed securities and treasury bonds, long-dated bonds. And that meant there was significant escalation of demand in those mortgage markets for those particular bonds, and that increased the price of those bonds because there's an increased level of demand. And that drove down interest rates. That drove down interest rates on those longer dated bonds, mortgages, treasuries, quite low, in fact, to record low levels. Previous record low levels had actually occurred during the financial crisis, 2008, 2009, 2010 timeframe. And those interest rates at that time stayed very low because the Fed took a very long time to start unwinding or engaging in quantitative tightening. So right now, the Federal Reserve has decided to stop engaging in quantitative easing. They've stopped buying those securities. They've actually started letting those securities that age out run off the books and not be replaced, which means that your 30-year loan, once you've paid it off, it goes away. It doesn't get renewed. The Federal Reserve has decided they're no longer going to take those proceeds from the payoff of the loan and reinvest them back into buying a new mortgage-backed security. They'll just let those run off the book, drawing down slowly the assets that the Federal Reserve has accumulated. And in fact, they'll start selling off some level of those bonds that they've got, mortgage-backed securities and treasury bonds. Now, as they sell those bonds, that is extra supply coming into the market where there may or may not be demand to meet that supply, and that extra supply is driving down prices on those bonds, which is driving up interest rates. And so this is a way for the Fed to almost directly impact the longer dated portion of the bond complex. And again, this is a new tool that the Fed has really only used once before. And so use of this tool is a bit blunt and a bit experimental. Use of the Fed funds rate is extremely blunt because you're controlling directly, but only on an overnight rate, and you're trying to influence the entire time duration of the bond complex. So the Fed's policy tools are blunt instruments with limited and somewhat unknown experimental effects on bonds. Now, why would the Fed decide to increase interest rates using the Fed funds rate and or quantitative tightening? Because the Federal Reserve has decided that if they increase the price of money, they can reduce the demand for money. And if they decrease the demand for money, they can decrease aggregate demand across the entire economy. In other words, they can fight inflation because remember, inflation is a generalized rise in the price of consumption. And so the more money that's available to people, the more leverage that's available to people, meaning the more money that they have access to, the greater the level of consumption, driving up prices. If we restrict access to money, we restrict leverage, we cut down on aggregate demand in the economy, and thereby we drive down inflation. Now, there's a problem with this. And actually, there's a couple problems with this. The first problem is as related to inflation. Remember, inflation can occur because of high levels of demand, but it also can occur because of low levels of supply. If demand is too high in the aggregate, increasing prices will help to drive down demand. That happens naturally according to neoclassical microeconomic theory. And increasing interest rates, which increases the cost of money, which reduces the access to leverage, which reduces the aggregate demand. Those reductions in demand work in parallel to reduce prices. There's less being demanded. So if there's less being demanded, there may be excess supply, which drives down price because people can't afford to buy, don't want to buy, and so that pulls prices back down. It certainly at least reduces the growth in prices. But not all inflation is demand created. Supply created inflation is a real thing. So what supply created inflation? Let's go back to the French macaroons. What if the supply constraint was that to make macaroons, I need to have, I don't know what goes in a macaroon. I need to have eggs, I need to have vanilla, and I need to have chocolate. And I can't get chocolate because chocolate is shipped from cacao plantations in Africa and Central and South America. And the shipping containers in which I would receive those cacao pods are stuck in port in China with COVID lockdowns. So I can't get the ingredients that I need to make the French macaroons, which means that I can't put macaroons into the marketplace. And so people could offer to pay me $50 a macaroon. I can't make them. I can't sell them. I don't have any ability to give you a macaroon, no matter how much money you give me. Well, that's a different kind of inflation problem, right? What if I could make some limited macaroons, prices go way up? That's inflation. And I'm supply constrained because of the supply chain. Or what if it's not supply chain, it's actually factor inputs into the production of macaroons. Half my macaroon chefs have left because they want to work for themselves, or they want to open their own restaurant, or they got a great job working at some other restaurant that just opened on the strip. I don't have enough macaroon chefs to make the macaroons. Now, maybe I could go out and buy some automatic macaroon making robots, but that's going to cost me a lot of money that I don't have access to right now. Or I could go around looking for people that I could train, but they're not going to have high proficiency in the making of quality macaroons, let alone high efficiency in the making of a lot of high quality macaroons. So that creates inflation because of a supply problem. Well, if it's supply induced inflation, increasing interest rates is actually not the proper solution. Why? Because as interest rates increase, demand gets cut, sure, but it doesn't make it easier for me to produce anything. In fact, it makes it more expensive for me to go out and hire people. It makes it more expensive for me to train people because remember, the economy runs on leverage. I've got to borrow money to hire those people because they're not pulling in sales yet, but I've got to be paying them. I've got to pay for their training. I can't buy those robotic macaroon makers because I've got to go borrow the money, and the price of borrowing money has gone up. And I can't build a new factory because I can't afford to build a new factory because the price of the money that I would need to build that factory has gone up. In other words, if inflation's being created by supply problems, increasing interest rates will exacerbate those supply problems even further. It will problematically get rid of some level of inflation on the demand side by reducing demand and reducing demand and reducing demand, but it's not helping anything on the supply side. So if the Federal Reserve looks around and sees inflation, and they respond as if all inflation is the same as all other inflation, and so they increase interest rates because that'll reduce demand, they're only going to be right some of the time. What do we have in the economy right now, in the US economy in 2022? We absolutely have inflation. There's no question about that. But is it demand driven or is it supply driven? So I'm not talking about houses. I'm talking about consumer products and services. Fuel. So one, the fuel market is a commodity market, and commodity markets are always, like other markets, subject to speculation and manipulation. And there's been a tremendous amount of manipulation in the fuel markets and the oil market over the past several months. So for example, Russia invades Ukraine. When Russia invades Ukraine, what happened to oil prices? They went up very dramatically. The price of West Texas Intermediate increased from something in the 70s to something in the $120 a barrel range, close to a doubling. It happened almost overnight. Now, why did that happen? It's a good question. What are the market fundamentals? Well, there's no change. At least in the short term, Russia continued and still continues to pump oil, to pump natural gas, to ship oil and to ship natural gas, to sell oil and to sell natural gas. So in the very short term, there is no change. Over the intermediate term, we've seen Europe say, well, maybe we'll stop buying Russian oil. We've seen the US say, the US will no longer buy Russian oil. We've seen India say, Russia, if you give us discounts, we'll buy some more Russian oil than what we had previously. Russian oil is still being pumped, it's still being refined, it's still being sold. Same thing with Russian natural gas. So the amount of supply in the market of oil has not gone down. And the amount of demand, Ukraine's using a lot less oil than it used to. So that's demand being pulled out of the market. So should oil prices really have been going higher? No. Now, some of it is concern over uncertainty. And there's an uncertainty premium in the marketplace for a lot of things. But this is simply manipulation by a lot of traders who've decided, there's something going on, there's headlines, and so what we're going to do is we're going to start bartering for oil in ways that increase oil prices, unreasonably in ways not actually connected to the market, to market fundamentals. So the price of oil has come back down. It's something between $95 and $110 a barrel now. So it's come down considerably, but not all the way. And it's still fluctuating in this large range. If Europe actually decides to ban Russian oil, that means there's excess Russian oil in the market. Now, certainly oil would go back into Europe from some other place, but the world is awash in the storage of and the production of more oil than what it actually needs. There's manipulation in the oil markets. Well, why do I talk about that? Because gasoline is a distilled oil product, along with kerosene, jet fuel, home heating oil, etc. These oil-based products have all gone up in price very considerably. That's inflation. And when fuel prices go up, that increases transportation prices because transportation is predicated on the use of fuel, and it increases foodstuff prices and other things that need to be transported. So when oil prices go up, that pulls the entire generalized increase in consumption prices higher. It drives inflation at a high rate. And we're seeing that in the economy right now. So is it because we have excess demand for fuel? No. Is it because we have too limited supply of fuel? No, it's because of market manipulation. But we also have in the economy supply chain constraints all over because we've got shipping containers locked up in ports in China that can't move anywhere because no products can be loaded to them because products can't be manufactured. which is also backing up ports in the US and other areas which are relying on the receipt of those shipping containers to be able to pack them with US produced products or US grown products to be able to ship them overseas to their final destinations or around the country to its final destinations. So we have logistically based supply chain problems in the home building area. This is a problem. We've seen lumber prices because of supply disruptions, because of COVID lockdowns, because of shipping problems. Lumber prices double and come back down and go back up and come back down. We've got, as I record this, we've got concrete shortages in the Las Vegas Valley. We've got national shortages in heating, ventilation, AC, ductwork, as well as AC compressor condensers across the whole country. We have shortages in appliances across the whole country. Trying to get high-end refrigerators, washer and dryers right now, problematic. These are not demand-driven problems, they're supply-driven problems. And if we can't get inexpensive access to funds, borrowed money, to improve our ports, to improve our airports, to improve our rail systems, to build the factories, to produce more chips that go into cars or cell phones, to produce more solar panels, etc., then those increased interest rates that the Fed is driving right now become problematic. They don't solve the inflation problem, rather they exacerbate the inflation problem. And this is a very real challenge right now. The Fed needs to be really careful about what it does with interest rates, because increasing interest rates may be highly contraindicated based on the type of inflation that we have right now. Is there excess demand? In some things, yes, perhaps there's excess demand, and so targeted increased interest rates might be appropriate, but just simply increasing interest rates, as some of the Fed governors have said recently, until inflation goes away, is a recipe for a problem. So what's the second problem? Right, the first is interest rates may be not appropriate for the type of inflation. The second problem is increasing interest rates are literally designed to slow the economy, to remove aggregate demand, to reduce aggregate demand. Reducing demand means you're going to cut down on the amount of stuff that's being bought. And if you cut down on the amount of stuff being bought, producers of that stuff, supply of services and product, will receive less revenue. When producers receive less revenue, they tend to lay people off. When they lay people off, those people who are laid off consume less. And you get this cycle, which is a recessionary cycle. And high interest rates induce recessionary cycles. Now, I don't mean to be alarmist about that, right? I mean, it's close to definitional. Increasing interest rates reduces aggregate demand. Reducing aggregate demand slows the economy. So the second problem is, if you slow the economy too much, you go into recession. Recessions are denoted by shrinking of the economy, which causes increased unemployment. Now, the Federal Reserve actually has a dual mandate. The two parts of that mandate are in conflict. They're in tension with each other, and they always are and always have been. One is to ensure full employment. The other is to keep inflation low. And so interest rates are used to keep inflation low, but interest rates have a problematic effect on employment levels, because increasing interest rates to reduce inflation also reduces aggregate demand, which leads to increased unemployment. And so there's a balancing point there. And the Fed is historically not able to use the blunt instruments of the Fed funds rate and more recently quantitative easing and tightening, to adequately manipulate the interest rate complex to slow the economy without tipping it into recession. And actually, you've heard multiple Fed governors, if you've been paying really close attention, over the past 2 weeks, start to say, we may actually push the economy, we meaning the Federal Reserve, into recession to get rid of inflation. In other words, this is starting to become, just now in May of 2022, stated policy on behalf of the newly reconfirmed Fed governor chair, Jerome Powell, as well as a couple of other Fed governors, that it may be necessary to tip the economy into recession in order to drive out inflation. Now that's a problem, right? It's a problem because why do we want to be in recession and increased unemployment levels? I hope you found part 2 of the 3-part mini-series, Inflation, Interest Rates, and the Housing Market, to be helpful and educational. If you have, please subscribe to our videos, smash the like button, and continue to watch part 3. You can click directly to part 3 at the box in the lower right corner of this video, or of course you can get there directly from the homepage for YouTube, Chong Miller Group channel. I look forward to seeing you in the next video.